Hello everyone, welcome to Stockertim, the investors channel. On this episode, I'll be talking about 10 mistakes you should avoid as a retail investor. As a retail investor, you have limited capital to invest. You also have a whole lot of financial goals in your life. So when you invest, you want to actually get your capital to work for you over time. You also want to get better returns over time. Yes, investment is not a day's job. You actually invest in the medium to the long term, and that's the best way to be an investor. But retail investors oftentimes make a lot of mistakes that oftentimes get very costly, and it also makes investment very difficult. But investment is very easy if you play by the rules, if you avoid costly mistakes that could actually make you or see you losing or your capital, see you not actually achieving your financial goal. So on this episode, I'll be reeling out all the 10 mistakes you should avoid as a retail investor and what you should do when you've actually made this mistake. If you haven't subscribed to our channel, subscribe, put on a notification bell so that you don't miss any update, and more importantly, please give this video a like, because as more people like this video, it will actually help more people. I'll get into the first mistake that retail investors make and why you should avoid this costly mistake. Come with me. So number one, chasing hype. So investment community is full of hypes, is full of pump and dumps, and you as a retail investor, because you might be new to the market or you don't have the kind of education that the biggest investors, the institutional investors have, you are likely to follow the hype or what some bigger some higher bigger buzzwords that is used in the market, momentum. You might want to follow the momentum, or what I will actually call the hype. You shouldn't follow hypes. You shouldn't be investing in a company because everyone is talking about it, because it is trending on social media, on Reddit, on X, on TikTok, on Twitter, or anywhere else. You should actually be doing your due diligence. You should take much time, invest in a company that you've actually done a little bit or more research about. You can also even compare notes with other investors, listen to the company, go into their balance sheets, go on their investors relation segment of their website, and make sure you understand how this company makes money, what they do exactly, how they sell their product or service, what is their debt profile like, also how do they actually deploy their capital, and more importantly, the people and the pedigree of the people behind a company before you invest in a company. So you could actually see so many stocks in the market today. You've heard about GameStop, you've heard about AMC, you've heard about, even Newsmax, you've heard about Weibo in recent times. Most of these stocks, they move very high into the sky at the beginning because there's so much hype. But at the moment, you think you are making money, but at the moment, it's actually a very risky, bet. So do not chase hype, and that will actually take me to the number two mistake retail investors actually make in the market. Another mistake, which is number two mistake retail investors make, is to overinvest. Overinvesting is a big mistake that a whole lot of retail investors actually make. Why is this a mistake that you should avoid? Come with me. So as a retail investor, you definitely do not have a huge amount of capital to invest. You are likely in a 9-to-5 job, or you are self-employed, or you are also in both 9-to-5 job, and you are also having something to do, what most people call side hustle. So you have your monthly or weekly or daily bills, your expenses that you actually run, your rent, your mortgages, your credit card bills, and other expenses of life. So you don't necessarily want to commit everything you have as a retail investor, as a typical person trying to actually invest. You don't want to commit everything into investing in the financial market or any other asset that actually needs time to yield, because investing is more or less like a marathon. And as a matter of fact, it's longer than a marathon. It's like a journey. You are planting a tree for generations, and it takes time for some of the biggest trees to actually grow. So you don't want to actually overcommit, you don't want to overinvest. You need to actually more or less have a budget of what you spend your money on, your discretionary spending, your constant bills. You want to actually accommodate those expenses in your bills, so that you don't have to actually draw down on your investment. Because once you start selling your investment in the short to medium term, you actually lose more money, because you haven't actually gotten the best returns for your investment. Investment, especially investing in the stock market, takes time. It takes sometimes years, sometimes decades to actually for you to actually get better returns. Yeah, you could actually be very lucky, but luck is not what is needed in investment. You actually need to, do your due diligence, invest for the long haul, so that you don't necessarily keep losing your money, because you actually want to pay your bills, you want to pay your rent and all that. That will take me to the third mistake that retail investors often make, and why you should avoid that. So the third mistake a whole lot of retail investors make is timing the market. Timing the market is a very, very big mistake that you are making when you think you can predict or time the market. Why is it very bad, or why is it a costly mistake to time the market? Come with me. It is very, very costly to time the market, because the market is very unpredictable. The market is not 2 plus 2. The market is composing of people, places, processes, natural occurrences, unnatural occurrences, human behavior. A whole lot of very, very unpredictable events actually happen. And at the end of the day, you don't actually want to be on the wrong side of the market. If you look at what happened with the tariff war that President Trump actually started, that actually sent a lot of jitters into the market, and there was a huge sell-off. So if you are a retail investor and you have predicted that the market will keep going up, and you kept on buying when the market was in its highs of the highs, around early to late January, you could actually have lost much more money by now. So that's why it is very, very wrong to predict the market. It is best for you to spend time in the market instead of time in the market. So that's why the big institutional investors, the pension funds, the investment banks, the hedge funds, and a whole lot of high net worth individuals, they don't actually time the market. They spend more time in the market. As a matter of fact, they wait for assets to actually lose value, and when assets actually lose value, that is the best time for them to step in, and actually intervene by buying a whole lot of assets that a whole lot of retail investors who don't have that knowledge have bought at a higher valuation. If you look at Nvidia has lost close to about 30 to 35 or almost 40% of its valuation in recent times. A whole lot of retail investors bought Nvidia when Nvidia was sky high. As a matter of fact, when Nvidia was already the most valuable company in the world. Now, Nvidia is now trading for much, much lesser, almost 40%. And that's why it is not always good to time the market. It's better to spend time in the market. If you have enjoyed this video up to this point, please give this video a like. We also appreciate all our subscribers. Subscribe to this channel, put on your notification bell so that you don't miss any episode. And also that brings me, and this takes me like a segue into the fourth mistakes retail investors make and why you should avoid that. So the fourth mistake retail investors actually make is when you actually buy what you don't know. And this is very related to the first mistake, which is following the hype or buying the hype. Buying what you don't know, it's not necessarily you following the hype. It's when you actually don't actually understand a business or a company and you're actually investing in this stock, or you are even shorting the stock. Why is this a mistake? I will explain. Just like I said in mistake number one, that is, it's very, very bad and a costly mistake to buy the hype or follow hypes in the market. It is also very, very, a big blunder or mistake to actually buy into a company that you don't actually understand. Why? Because companies are like human beings. Human beings are very complex to predict, are very, very complex to read, or to actually even decipher what someone is thinking. So, just like a human being is also very, very difficult to understand, companies actually is composed of a whole lot of people, passion, processes, systems, ambition, vision, and mission. And you actually need to understand what this company stands for. For instance, let me make it relatable. I invested in Palantir because I understand the vision of the company, being a company that wants to produce or design or develop the best software that will protect Western civilization. That vision is very, very connected to what I actually believe in, because I believe that the Western civilization has so much to give as being a blessing to the world, and it's also something that, if it is properly vetted, if it is properly checked, it could actually be a better force for good. So that was why I invested in Palantir, and they were developing a software that no one is actually thinking about, a software that can connect every source of human intelligence together, piece it together, and allow you to predict, to determine, to make decision, and to also build amazing product, services, and even stop crime, stop war, and also win on the battlefield. That is a company that I took my time to actually, research and understand what this company stands for. Even when there's some part of the business that is confidential, I was able to actually understand what the software actually does, how it works, and how this company has connected its products and services to its vision. And that's why, when this business did well, I was able to actually profit very, very well from this stock. So that is it. So if you don't understand a company, it is not, you don't have to actually know everything, but you actually benefit more when you buy what you know, what you understand, what you believe in. And that takes me to the fifth mistake that retail investors actually make in the market. And we'll wrap it up for the first part of this episode. Come with me. Number five is when you actually tune yourself to the huge barrage of news articles, news headlines, when you react too much to news. Why is this a mistake, and why is this problematic? I will explain. So the world is filled with information. As a matter of fact, we are in an information overload period. We have so much news headlines, TV stations, streaming platforms, social media networks, a whole lot of influencers, bloggers, a whole lot of people who are very, very smart, and some other people who pretend to be smart, and other people who actually copy other people who think they are smart. So you, as an investor, you are now in a situation where you have an information overload, especially the news headlines that oftentimes, some of them, they tend to be very, very negative, like the tariff war that started, how President Trump was tweeting almost every minute, and China was also giving it back, and it became a tit for tat. Also, if you look at so many things that happened during the COVID pandemic, the lockdowns, the unfortunate passing of so many people across the world. It was so intense that a whole lot of retail investors gave up investing, and they left the market. And the market actually tanked. But because you are a retail investor, you don't have the financial infrastructure, you don't have the technological infrastructure to get back into the market when the market is now positive. So what happens is that if you panic and react to news too quickly and too early, you end up coming back into the market and buying assets or stocks or securities at a very huge premium, and you end up having to wait for so many months, so many years to actually make profit or even to break even. So why is this important? As a retail investor, you want to stop overreacting. You want to stop being too sensitive to news headlines, because some of these news organizations, some of these bloggers, some of these influencers are not necessarily neutral. Some of them already have interest or short interest that they predicted that a stock will actually go down in value, and when that stock goes down in value, they make much more money. So if you don't understand what the importance of a news headline is, take time off and actually do some more research, or even take time off, because most of these news headlines, you see a negative news and you see a counter positive news coming almost right after. So, and that's why it's very, very a costly mistake for you to make when you react too much to news headlines, whether positive or negative. So that is it for the first episode of the first part of this special episode, the costly mistakes, 10 costly mistakes that retail investors actually make. So we have talked about the first 5 mistakes. So in part 2 of this episode, I'll be talking about the 5 remaining mistakes that retail investors actually make and why you should avoid them. These mistakes are not cast in stone. There are much more mistakes that retail investors will actually make in the journey of being an investor in the financial market. But investing in the financial market is very, very rewarding if you follow the rules, if you don't buy the hype, if you don't keep buying what you don't know, if you stop reacting to news, just momentarily, and if you actually do not time the market, because timing the market, buying what you don't know, following the hype, following news headlines could actually make you lose more money than you've even invested. So thank you for watching this episode. For the next part of this video, I will be talking much more on how you can avoid this mistake. Please give this video a like, subscribe to our channel if you haven't subscribed, put on the notification bell so that you don't miss any updates. In the next part, I see you again. Take care. Bye-bye.